Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Hello and welcome to the Mineral Rights Podcast. I'm your host, Matt Sands, and I'm joined by my co-host, Justin Williams, and we're here to help you make the most of your minerals and royalties. In this episode, we're going to talk about the way that oil and gas wells are forecasted. What I mean by that is how we determine how much oil or gas an existing or even a future undrilled well might do in the future. So, Justin, this is kind of a technical topic we're going to talk about today, but we're going to try to boil it down so that anybody that, whether you've just inherited minerals and royalties and are just trying to figure this all out, or if you've been at it for a long time, hopefully give you a few tools to at least understand, when you hire somebody to get a valuation or try to understand, what your property's worth, that this is the process that they're going to use, and you can have an informed discussion with them about the assumptions that went into their analysis and be able to understand, how they're looking at your property in particular. So this was fun to put this together, and I think it was a great catch by you to add this to the list of topics, because it's really not something we've gone into depth about in the past.
You nailed it, Matt. And I think, mineral owners, this often comes up more when we're thinking about selling the property, perhaps when we inherit the property. But the information that comes back from an evaluation like this is really very useful to the mineral owner. I mean, if you can imagine a spreadsheet that shows you month by month the potential income that you might be making from a well, I think a lot of mineral owners don't even realize that there is that kind of methodology that can be done, and that it is something that can be predicted in that way. A lot of times we think of it as, don't get too comfortable, right? Because we don't know where the checks are going to go, but there is more information available than you would think. However, this isn't something, again, that we really do proactively. Typically, this is something we're thinking about when we sell, when we inherit, when we're required to do this process. Yeah,
that's a great point. I think there's a lot of practical use cases for this type of analysis for a mineral and royalty owner. Like Justin mentioned, if you want to figure out what your well is going to produce and then the resulting royalty income that you can expect just from a budgeting standpoint or maybe from a tax planning standpoint, because, we oftentimes, if you have a significant amount of royalty income, you're having to make estimated tax payments, quarterly, or you might face a penalty at the end of the year if you underpay your taxes based on the income that's coming in. So if somebody has a windfall, significant amount of royalty income relative to everything else, that those estimated tax payments become really important, and getting accurate means that you're not paying more than you should and having to get a refund. And whereas you could have earned interest on that money throughout the year if you had held it in your bank account or invested it, or on the flip side of that, if you maybe underpay significantly, and then you're having to pay a penalty and that kind of thing. So you can get really pretty accurate. Obviously there's a lot of variables, and we'll talk about what those variables are, but you can get pretty accurate depending on the type of well and the age of the well and all of those things. And so it's something where I think it's important to understand that these types of tools exist.
You said it, Matt. And again, this is a highly technical process, and we're going to kind of go through that. But I think that's what scares a lot of folks off, is that it comes down to engineering. It's math. It's understanding the well. It's something that it has a price tag that is not small associated to it because of all the research and industry expertise that goes into being able to interpret this information. And Matt, to kind of lay the foundation. So does this apply to both vertical and horizontal wells? I know things changed a bit when we went horizontal, and I'm sure that this changed along with it.
Yeah, you're absolutely right. So there's, no matter what type of well, again, like Justin said, if it's an old conventional vertical well that was drilled 75 years ago, or if it's a new 3-mile long horizontal shale well that was drilled 25 months ago, that is the similar process is used. Slightly different math goes into those different scenarios, but basically the same process is used. And what we're doing here and what we're going to talk about is the process for modeling the declining production rates over time of an oil or gas well based on physics, the natural reservoir energy, the things that are happening within the well itself or within the reservoir. We can use that information and the similar characteristics for different types of wells to fit a curve to that. And even if you don't know that information, you can actually get pretty close in fitting a curve and using that future, the future dates and the stuff that's going to happen that hasn't happened yet, but based on that curve fit, and the closer that curve fits to the existing production data, the more accurate the forecast will be. But that whole process is called performing a decline curve analysis, or a DCA. Essentially, Justin, you can use this process no matter what type of well. Now, there's some exceptions if there are wells that are on enhanced oil recovery. So an example is that the well is not declining, right? So you have just flat production month over month because there's a water drive going on, like an water flood or a CO2 flood. And that production, they'll do this after that initial primary production tapers off. And this decline curve analysis is generally used during primary production, where there's that natural reservoir energy that's causing the natural depletion or natural decline over time. You can't use this for wells that are constrained by pipeline capacity. So let's say they're curtailing production because there's not enough capacity in the pipeline, or the pipeline pressure is too high to allow the well to flow naturally. And so that becomes an issue with modeling or forecasting production. Or if you have a water drive reservoir where you have that initial production that's flat until that water breakthrough occurs. And so, again, if you're looking at the Railroad Commission website or the Oklahoma Corporation Commission or whatever your state oil and gas commission, and you look at the production month to month and it's basically flat, that is something where this process won't work, because there's something physically that's happening to that well that's causing that to happen. That is something you can't model using this method. But for every other well, so I would say like 95% of the wells out there, this process is what is used when we forecast production and when we actually perform evaluation or appraisal to figure out what the value of the property is, again, based on that production or what that potential production is.
You said it, man. And, there is some speculation that goes into this, and it really takes some experience being able to interpret this data. But I wouldn't say it's guesswork. It's been proven and used successfully for 80 years. This is integral to the oil and gas companies because it allows them to have an idea of what they're working with, what they can do, what they can produce. And Matt, there's a few different phases that wells go through. And I think as mineral owners, we're aware of these. And I thought some of the names here associated with these were kind of funny, but there's the honeymoon, that initial phase where production goes way up. And as mineral owners, we always hear, hey, don't lose grip on reality because your checks may not stay that high. There's that transient phase where the pressure is going to decline, and it may be somewhat steady during a long period. And then there's going to be that slow, steady decline, which with horizontal units, that could be a really long time span that the decline happens over. But this adds a lot of clarity to that and the science behind why that happens. And it has to do, Matt, with the natural reservoir pressure and, what can be pushed through doing these so much. What would you say are they pretty consistent? Do you feel like this is an easy thing to apply? Do you feel like it is a really difficult thing to be accurate with this?
No, it's actually, I would say even more so with the advent of the shale revolution and these horizontal wells. There's kind of a typical model, especially within a basin or a play or a certain formation. You'll see trends start forming, and you'll see similar characteristics to these curves that you're fitting to the data. Some of the parameters that we use to forecast production are the same or within a certain range for a particular area. And you'll start to see these patterns evolve and emerge. And so from that standpoint, it is actually to the point of where, okay, I know that for a new horizontal well, it's going to have this initial spike up. And then after a certain period of time, I can fit a hyperbolic decline curve at the very beginning, and then it'll transition to an exponential decline or kind of a steady decline or constant decline at the tail end of the well's life. And knowing that, you can say, okay, well, I'm going to constrain and we use computer software to do this. So it's not something where we're getting a graph paper out and doing it like they had to do it back in the 50s or whatever, with slide rules and things like that. So it's all computer driven, and a lot of this is automated now. And we were talking before we hit record how probably AI is going to start playing into forecasting wells based on these large data sets and all this information, which is basically all the information that's out on the State Oil and Gas Commission website. You have all this production data, millions of data points for a given area. So that's very useful in fine tuning these algorithms basically to forecast production. But yeah, I think like you said, there's these kind of different phases in a well's life that you can, knowing what you know about how reservoirs deplete over time, right? When you first drill a well, you would expect the reservoir pressure to be the highest. And then as you're pumping the oil and gas out, the pressure drops and the decline, the production will drop as well when it's on that primary recovery mode. And that at that point, you can say, okay, well, I'm going to fit this type of curve, and here's the parameters I'm going to use based on the area and based on the empirical research. So again, this is all looking at like historical data on existing wells that we come up with these hypotheses and themes about, okay, this type of well is going to look like this over the life of that well. And then we apply those models and then, and use that to come up with how much oil or how much gas, and then resulting how much the value of that production is, and, both to the oil companies. So this is the process that oil and gas companies use to estimate the value of their reserves. So that's the unproduced oil and gas that's underground still, both the stuff from existing wells as well as things they haven't drilled yet. This is the process they use for that. And then also for a mineral and royalty owner, this is what we use to value our minerals and royalties as well as forecast our future royalty checks. So it's a very useful tool, very useful process. And again, like Justin said, there's some kind of standard themes that we see with all oil and gas wells, with the exception again of those that are on that secondary recovery, whether that's water injection, gas injection, or CO2 injection. Those are exceptions. And again, if there's like some artificial constraint you're applying, that you're limiting the amount of production on the well, then that you're going to mask the natural characteristics or behavior of those wells from a production over time standpoint. So that's something where you'd have to figure a different way to estimate the reserves or the value there. But yeah, so for most cases, this is the process that's used.
You said it, Matt, and we mentioned it's been used a long time. Just a quick mention on the history. So in 1945, J.J. Arps, U.S. geologist, first published the decline curve equations that are still used today by most major oil companies. And then in the 1980s, Mike Fetkovich refined the analysis for modern reservoirs and helped bridge the gap between simple decline curves and complex reservoir engineering. And those are still taught in petroleum engineering schools today. These are still, like Matt said, applied by the oil and gas companies. They're very useful for mineral owners. And we've mentioned the reservoir a lot, Matt. I think as a mineral owner, we don't necessarily think about the reservoir as much, right? We're more focused on our little piece of the property that we own. But a lot of this data actually comes from the data driven by not just your well on your land, but all of the wells in this single reservoir. And for those that may not be aware, Matt, we kind of refer to the reservoir in different ways. The Wolf Camp, those are all, we're referring to kind of these reservoirs, but these are well known. They're researched. The data is published as far as where these reservoirs are. Do you want to talk a little bit about a reservoir for somebody that maybe doesn't know how someone like an engineer like yourself is looking at that?
Yeah. So when we talk about a reservoir, it's not like what we would think, when you look at a reservoir of water on the surface, it's not a big pool of oil or a big pool of gas that's, in a big pocket. It's actually embedded in the grains of the rock. So if there's pore space within rock, and maybe it's very microscopic and very fine, depending on the type of rock it is. Like the one that we used to consider a seal or a trap, in other words, that gas or oil wouldn't flow through, is a shale. And now that's actually what we produce oil and gas from through hydraulic fracturing, where we can create artificial fractures to allow a network for the oil and gas to travel along into the wellbore and then going up to the surface. So those, what Justin's calling a reservoir, we have these different formations, so the different geology that exists below the ground that we know through coring. Basically in the past, maybe a vertical well was drilled and they took a core sample, and a geologist looked at that and saw the oil and gas trapped in the rock at certain layers. And they said, okay, we know oil and gas is there. In the past, shale, we couldn't produce it economically and it wouldn't flow because it's that rock is so tight and so fine grained that there was no way for the oil and gas to flow through it until you cracked it, basically. And then there's other like sandstones and things like that maybe have more porosity, more permeability, or basically more ability for the oil or gas to flow through it. And that was what we typically produced from, up until the early 2000s. Those are what you would consider a quote unquote conventional well is through like a sandstone or other type of rock that has a certain level of porosity and permeability that would allow the oil and gas to flow without us having to do much. So, again, reservoirs, think about that as a certain type of rock or formation where the oil and gas exists. And in the past, it was something where there was a trap. In other words, that shale layer or something geologically that prevented the oil and gas from migrating up to the surface, and it would sort of accumulate. But again, when it accumulated, it wasn't in a big pool, in a big pocket. It was actually within the rock formation. And so they would drill, try to find out where the oil and gas was, and then try to hit the sweet spot of where that oil and gas was sitting there in the grains of rock and then produce it. So that's kind of what was done in the past. And again, now it's typically in these super tight, shale formations or in the past, what we consider more of a trap or things like that. But it's the good thing about that is it's usually pretty uniform and it's in a layer. And so by drilling horizontally through it, we can produce a lot of oil and gas. So in any case, that's a little bit of background about how we look at and how, geologists, reservoir engineers, petrophysicists, determine where and how much oil and gas is there.
You said it, man. And for the mineral owner, for the individual well, that's going to impact how is it that we expect your well to perform based on that reservoir and how units in that reservoir typically perform. And they call it the B factor, Matt. And that is kind of a unique fingerprint to that reservoir, gives you an idea of how that is going to go through the decline, whether that'll be exponential decline, whether that'll be a moderate decline or a gradual decline. And then, Matt, you've mentioned these words a little bit as we've talked about this, but then you have the different types of declines. So, Matt, you've mentioned those declines. And when you're matching that decline curve to this well, there's a few different types of defined ways that those decline. You've mentioned the exponential. You've mentioned the hyperbolic. What do those mean, and how are we determining what curve this well might follow?
Yeah, so the way that we look at that, and again, it goes back to that B factor, which, again, this is all just a variable in a mathematical equation. And generally speaking, based on the type of well or the type of performance or, the characteristics in terms of production by month. And so when we were looking at this and trying to forecast wells, we plot production on a semi-log scale. And so what that means is the production rate in terms of, say, 1,000 cubic feet per month or 1,000 barrels per month. That on a vertical scale, that's on a log scale. So what that means is it's not linear. It's not like 10, 20, 30, 40, 50. It goes, you have a log plot, which again, you just need to Google what a log plot looks like. It's hard to explain this on a podcast. If we were showing this on a video, which we'll probably do in the future, we'll record a video on how this is done and give a demonstration. And in fact, I do have a YouTube video out there where I do talk about how to perform a decline curve analysis using a tool called Well Database. And I show how you can use that to forecast your future royalty payments. Now, this is something that I do for clients as part of an appraisal or evaluation, or if they want to just get an estimate for, hey, what's my monthly royalty check going to look like with these new wells that are getting drilled? That whole process is basically what we're talking about today. But you can do some of this, knowing some parameters and knowing some certain characteristics for your particular area. You could potentially use a tool like Well Database, and they're automated, curve fitting, and you use that to adjust it to make sure that the curve fits the historical data. And we'll talk about how you would go about doing that, but you do need to kind of know what you're looking for. So the parameter that, like Justin mentioned, is the B factor. With a hyperbolic curve, that decline curve, the amount in that decline rate over time is constant. That constant is called the B factor. And so when you apply a hyperbolic curve, and there's a certain equation that you use that determines where that B factor will determine what that curve looks like. But basically, if you can imagine this, there's sort of two key parameters when you're fitting a curve to production using that hyperbolic decline. And this is the primary method that we use for forecasting modern, shale well in the early part, or the kind of the first, say, half of the life of the well. And that is that there's an initial decline rate, which determines how steep that curve is at the very beginning. And then the B factor is the bend of the curve, and that'll determine that bend and how much it bends. And if it goes down more, or if it goes more flat as you go out more into the future. So that steepness, again, is determined by the decline rate. And then again, the bend in the curve is dependent on that B factor. Now, that B factor, there's a couple of things that happen. If a B factor is 1, that's a harmonic curve. And that's not a very common, typically we're not using that as the main method of figuring, the forecasting the wells. What we look at is that there's an initial B factor, and that's usually between 0 and 2. Again, not usually right at 1, but usually kind of above 1, or if it's, a more steep decline or more, less production, it's usually below 1. And then if the stage where it's actually a constant decline year over year, that's where the B factor is 0. And that is an exponential decline. And that's where you have just a constant percentage rate. That an example would be like maybe 8% decline every year. And that's just steady eddy, at the end of the life of the well, that's just going to be on that kind of straight line. When you plot it on a semi-log plot, it looks like a straight line, just because that decline rate is constant. So, hard to explain, easier to show on a picture, but we look at a modern well, it's typically a hyperbolic decline at the beginning, where it starts out really steep, and then you get a lot of the production up front, and then it flattens out. And then after a certain point, when it reaches a certain rate, say 8%, 15% per year, it just stays constant. And so we model this as sort of a two-part curve fit. The first part of the life where it's a hyperbolic, and then the second part where it's an exponential. And that's the process that is used for performing a decline curve analysis on most wells today.
And Matt, not to leave out natural gas or other plant products, they can also be calculated using ratios to the primary product. So for oil wells where gas production closely follows the oil production, one can use a ratio of gas to oil to forecast the gas production. And Matt, I assume that plant products are pretty similar to this, but it all kind of goes hand in hand into doing that evaluation. And you're able to kind of get an idea of that. And we've talked a lot about the foundation that kind of sets this. And when it comes into doing your actual evaluation there, some of the things that you're using are, similar wells that are nearby, normalize things like lateral length. You have to normalize time. And then the decline curve analysis on the average production or each and average after, which I'll let you explain this a bit more, Matt. But I think, me as a mineral owner, I want to go, hey, Matt, can you just do the spreadsheet for me that tells me what my estimated income is going to be over time? But there's a lot of data that you have to look into to create the evaluation as a whole, and then even just that piece of the evaluation. It's not something that it's just easy to pull up.
Yeah, so I think that just on the first part that you mentioned, there are some things that we use a formula to forecast, and a great example of that, you can use that for gas as an example. If there's a ratio of gas to oil that's constant, that's the gas to oil ratio, or GOR, and that's expressed in units of standard cubic feet per barrel, or 1,000 cubic feet per barrel. And so that is something that can be used. So you can use an equation. So in other words, you would put the curve fit on the oil production, and then you would just use an equation that said X number of 1,000 cubic feet per barrel of oil, and it's constant. And that's what we're going to use to forecast the gas. Most typically, we actually will do a curve fit for the oil production, and then use the historical production for gas, and apply a separate curve fit to the gas, because those will be sometimes different, or most likely different. And then have two models or two curves, one for gas, one for oil. And then for areas where you're receiving, or that well is actually producing a very rich gas, in other words, it has a lot of hydrocarbons in the gas, it's got those plant products or natural gas liquids like the propane, butane, things like that. We'll apply just a standard ratio called the NGL yield, the natural gas liquid yield. And what we do is just look at existing production, again, whether that's on your wells, and if you have enough production history, you can do this to figure out how many barrels of natural gas liquids are produced for each 1,000 cubic feet of gas, and use that ratio to forecast what the natural gas liquids production will be. So we don't fit a curve to the natural gas liquids. We use that formula. And then similarly, we'll have to figure out what the shrinkage, and when we actually are doing the economic model, the gas volumes that are reported to the state reflect both the NGLs that are in there as well as the resulting natural gas. And so we have to reduce the volume of natural gas if we're stripping out that natural gas liquids and putting that formula together for the future natural gas liquid production, if we're forecasting that separately. And that's called a shrinkage. And that's where the gas shrinks because you're extracting out those natural gas liquids. And there's a formula we use for that. And it's all in these these software programs that we use that run the economics for oil and gas wells. And it all does this in the background. So you put in those ratios and say, okay, this is the formulas I would like to use. And then it'll figure it out. But to your point, I think the thing to know is that, we use the data. So there's a lot of data out there each month that a well produces. The data is reported to the state. It's publicly available, and we can use that information to forecast the production on those existing wells. Or like what Justin was alluding to in the second part there is if a new well is going to be drilled, we want to know how that well is going to perform so we can determine if it's even going to be economic to drill at the current prices, right? Or if we want to know from a royalty owner perspective, how much we're going to receive in royalties from these new wells that are about to get drilled so that we can use that for budgeting or for tax, purposes. So the way we do that is by building what's called a type curve. And that just refers to like a type or typical well in that area. And I'm taking the production from all of those similar wells that are existing in that area. And nowadays what we do is we look at, okay, if we think, for a horizontal well, for example, we look at wells drilled in the last 10 years that have a similar completion methodology, the frac design, the number of stages they use, the amount of water, amount of sand that they use. And that kind of, I'd say certainly in the past, say 5 years or 7 years, we've gotten to a kind of a level where they've optimized that, and we know, okay, this is how these wells are going to produce. So we try to say, okay, in a certain period of time where we have a similar design that we're using on this new well that was from a previous well that was drilled, I can use that historical production from those old wells or the existing wells to figure out what that new well is going to do. And that's, again, building a type curve. And again, all it is normalizing for things like the lateral length. So if we knew our new well is going to be 10,000 feet long in terms of that horizontal length, we can adjust that up or down based on the length of those existing horizontal wells. We can also time normalize it. So that means some wells were drilled in 2019, some were drilled in 2021. But if we all look at what each of those wells produced on month 0, month 1, month 2, month 3, and we overlay that on top of each other, we can then come up with an average curve and then fit the decline curve to that average as one way. Or there's others that will argue that actually performing a decline curve analysis on each of those existing wells and then averaging that together is a little more accurate. But either way, you average out the production and you come up with a forecast, a curve. And then what you say is, okay, I'm going to use this curve, and 2 years from now, a new well is going to get drilled, or next year or next month or whenever the time is. This is the curve. I want you to start production on that date following this curve. It'll put it into the model. And then what you end up with is a discounted cash flow analysis, basically. So you have production from existing wells and the production from the new wells. You have commodity price forecasts that you come up with, which we can talk a little bit about as well. And then some of those things that we mentioned, like the natural gas yield, the gas shrink, things, the natural gas liquids yield, the gas shrinkage, the tax rate, whether that's severance taxes, things like that, and state taxes. And then that comes up again, like I said, a discount. You have a discounted cash flow model. You discount it back to today's date or whatever date you're interested in. and based on that interest rate, and then you come up with what the lump sum is today for the value of that property, that fair market value. And that's what when we perform a valuation or appraisal, that is the process that we use to come up with the value. And again, it's massaging these models to make sure that they're accurate and reflect historical data, and then to best of our ability, what's known or knowable, come up with a defensible economic model, basically, what a likely development scenario might look like for any undeveloped acreage and things like that. And all of that together you can use to estimate your royalty payments and then figure out what the property's worth. So this is the process when you hire somebody to get a valuation or appraisal. If you're going to sell, let's say you want to know what the property's worth, so you negotiate a fair value. This is what the buyer is doing on their end. They're using their own proprietary model to figure out what this property's worth and how much they want to offer you. And on the flip side, you should be using this type of methodology to figure out what your property's worth to make sure you're getting a fair price. Or if you need an appraisal for establishing a step up in basis, let's say you sold the interests and you need to figure out what they were worth in 2005 when you inherited them. This is something you can go back in time and do this, based on what was known in 2005 and use the same process. So in general, this is the methodology that we use.
You said it, Matt. And one thing you've mentioned a bit throughout this is the commodity. Oil is a commodity. There's a few different ways to determine that. Do you want to talk a little bit by whether we're using NYMEX, strip prices to determine this? You could use a constant number. There's a few different ways to go about doing this. But, once you decide what is the well going to flow, the other thing that plays into this is what is the price of oil? What do we think the price of oil will be and was?
Yeah, and that's always the biggest variable. We can get pretty close and pretty accurate on the well forecast. It's the unknown aspect is, 2 years from now, what is the oil price going to be or what's the gas price going to be? So what we do is use the best available information, which, like Justin mentioned, is things like the market, what the market thinks it's going to happen. And that's basically the futures prices, which is the NYMEX strip price, which you can download that month by month, what they think it's going to be into the future for the next 10 years. There's banks that do this, and they're a little more conservative. So they have a bank price deck that'll, usually go out, a couple of years, and that'll have a month by month what they think oil and gas prices are going to be. You can use the SEC method. So when oil companies placing value on their oil and gas reserves, they use this process, and that uses basically the average of the first day of the month price for each month, over the past 12 months, prior to when you're actually doing this analysis. So basically for the year, you look at, okay, what were the historical prices at the beginning of the month, and they'll use the average of that as the value going forward. Or you can just use, hey, I think it's going to be $60 a barrel, or you want to be conservative, or you want to be aggressive. You can adjust that number accordingly. And so right now, when prices are in the mid 60s, maybe you use a $60 a barrel. I think that oil will probably average $60 over the life of those wells, is what you're saying. And then, you would use that number there. And each of those will give you a slightly different value, and you can adjust that. It's basically a linear relationship between the value and the commodity price. So if you think when you ran the model, you thought it was going to be 60 and it actually turned out to be 80, well, you can, apply that factor to adjust it upwards. 1.3 times the value that you came up with would be what it is at that higher price, or vice versa. If it's you thought it was going to be 80 and it's 60, you can scale it down accordingly by 75% or whatever. So that's sort of how you would look at it.
All right, man. And so for other things when it comes to decline curve analysis, what would you say is another thing that mineral owners specifically usually miss about this information? I know we were kind of talking before we hit record. I think one of the biggest opportunities for mineral owners is an understanding of what data is really available. And, nowadays, typically when these wells start to flow, we receive these really large checks initially, and then they kind of taper off. And having been a mineral owner now and gone through a few wells, it makes a lot of sense to me that this would be a worthwhile investment when that well comes online, not only for the tax purposes or if we choose to sell, but also for being able to predict in tax liability.
Yeah, that was all, I think, the main use case, from a mineral and royalty owner perspective. It really just depends on what your plans are. If you're planning on selling, I'd say this is absolutely necessary to know what the property's worth. Otherwise, you're just guessing. You're relying on the buyer who's by virtue of the fact they want to make money on the deal, they're going to offer you less than what the property's worth, ideally, because they want to have a bit of a gain there, right? A little bit of a margin. And then also, the thing that you need to take into account is that there are limitations to this process. You need enough data in order to come up with a reliable curve. When you have, let's say, a brand new well and it's in an area where there's not very many other wells that are like it, it's hard to predict what the well is going to do until you have at least maybe 18 to 24 months of unrestricted production data. In other words, it's not curtailed. It's not something where they're limiting the oil production because there's not enough pipeline capacity or whatever. You need to have it free flowing, and this is what the reservoir looks like based on the production. You can use that then to come up with a more confident forecast. If you do forecast wells with limited data, there's more uncertainty. It's certainly out into the future. It's a little bit of a guessing game. What that curve is going to look like 15, 20, plus years from now. You could be way off. But from the next, especially when you have, let's say, 2 years of clean, data, you can get pretty darn close over the next 12 months, which is really where we're mostly interested from a mineral and royalty owner perspective. We're holding on to these interests and we just want to know, okay, what do I need to budget for my wells? You can get pretty darn close. And then, as oil or gas prices go up or down, you can adjust that accordingly and then fine tune that. But those are some of the limitations or some of the things to be aware of. And certainly as these wells, at the very beginning of the well life, there's more uncertainty because, in that particular area, there may be some nuance that will cause the well to perform differently than the type curve. So it's not uncommon. So that type curve is not gospel. It doesn't mean that every well is going to follow that type curve that you come up with. It means that on average, it will produce accordingly, but 50% of the time, the well will produce more, and then 50% of the time, a well will produce less. So it can, on average, right, you think about it, averaging all of that out, half of those wells will be above the curve, half of them will be below the curve. You just don't know exactly where your well is going to land until you have enough data to see how it's trending relative to that type curve.
That makes a lot of sense, Matt. And for folks that are managing their minerals, we talk a lot about, does it make sense with the size of your interest? And I think that is a very relevant question when it comes to having evaluations done. First and foremost, though, can you do it this yourself? Yes, you can, Matt, and you have a YouTube video. But can you give just a quick high level on maybe how long it would take a mineral owner to sit down and do this for a well?
Yeah, for one well, it's, using a modern tool. Again, I show how to do this using Well Database, but there's many other tools out there that sort of automatically fit a curve to production data. And that's sort of the service that different companies provide is these models that they've come up with that do this in a very quick manner. They'll automatically come up with those decline curves and come up with the things you need to fine tune maybe, but it has an initial fit to each well, and you just maybe have to go in there and look at it, make sure it looks accurate. So in some cases, this is done nearly instantaneously. But if you're doing it manually, like I show in the video, that it's just a couple of minutes. You look at, and certainly for a well that has, again, like we talked about, a couple of years of production, there's a couple of buttons you click in Well Database and say forecast production, and you can input the range of the B value. And I say typically you want to use a B value less than 1.3. I think that's a good conservative number for most wells. And then, when you get to that end of life, the terminal decline rate of around 8% is pretty constant and pretty conservative and pretty good to use when it flips over from the hyperbolic to an exponential decline. So, I think those are things that you can use that video that I talk about and see how it's done. So we'll link to that in the show notes. So this would be kind of important just to see what we're talking about. I think watch that video. It's pretty cringeworthy from my perspective. I recorded it probably at this point. I think it was maybe 7 years ago. So it's a little rough around the edges, but you can get the gist of the process from looking at that video. And then if you want to follow along and do it yourself, you could always get a month subscription to Well Database, do that decline curve, export it to Excel, put in your decimal interest for that well and put in your estimated oil and gas prices, and then use that to figure out what the monthly royalty income is going to be. And that's exactly what I show you how to do in that video. There's useful applications to this from a mineral and royalty owner perspective. You have to be careful with it because there's some nuance to making sure that it's going to be accurate. And in that video, I talk about some of those nuances. If you have a significant amount of income, it's highly advisable to get a professional to do this for you so that you are using reliable data to make decisions upon. Somebody that kind of does this day in, day out, knows what the limitations are, what kind of models to build, because, ultimately you could be overestimating or underestimating the value if you use the wrong parameters.
You said it, man. And I think, something else that comes up that we don't often talk about or realize as mineral owners, there is a difference in, what we're able to come up with as far as data with ourselves, and then what the IRS is going to accept by a defensible evaluation of the property. And so if you're going through a sell situation, an inheritance situation, it may be that you need an IRS acceptable appraisal. And that's, not something you're going to sit down on a well database and do. It really needs to come from a professional.
Yeah, absolutely. There's a lot of documentation that needs to go into it, a lot of things you need to document and models to develop that are in a certain way that will, again, stand up to a potential audit or, be following industry practice so that you can make sure that you're making decisions based on the most accurate information possible. Now, unfortunately, there is a cost associated with that. But again, it can mean the difference between if you're selling a property and you want to establish a step up in basis and you've inherited the property in the past, 10 or 15 years, and there's a lot of horizontal drilling in the area, there was probably significant value when you inherited the property. And so you can potentially establish a higher tax basis and pay a lower capital gains tax on that resulting sale with that information. So you'll essentially save money in the long run on taxes more so than you would pay for the appraisal. So it becomes, a good financial decision from that standpoint. Or again, like I said, you don't have to go to the extent of a full IRS appraisal and, using the US PAP format, that's the appraisal practices. That is something you can just get a quick and dirty valuation. And I use that term to differentiate between an appraisal. So evaluation is using the same underlying methodology, but just coming up with a basic outline. You still get the same cash flow projections. You still get the same or similar, maybe not quite as fine-tuned, but a high-level value range. And you can use that to make an informed decision about whether you should sell or whether you want to keep minerals based on the offers you're getting. And so that's something that I think is, useful for mineral and royalty owners to know that option is out there, and then how they go about, if you hire somebody, what they're actually doing behind the scenes to come up with that value, and that it's based on established science and established engineering practice, and how you come up with those values. It's not just a dart on a dartboard or, multiple of cash flow, which can be useful in some cases, but it's a very much more scientific way to go about it.
You said it, man. Well, I think we've kind of summed this up, and I hope this was useful for folks and for mineral owners to kind of understand what the value of this is, and maybe it'll open some people's eyes to getting some more evaluations, or at least looking at getting an evaluation on your minerals when production starts, so that we can better plan. Again, I think mineral owners we see this industry as we're very grateful and thankful for the opportunity for the income to come in, but also a little bit leery of it because we don't feel like there is a science behind what we might be able to expect. And there is. It's just highly complicated, but oil companies have been using it for years. Yeah,
exactly. I think it's that initial shock, that really large initial payment, and then, 3 or 4 months later, you're asking, why has it dropped so much? Is there something wrong with my well? What's going on? Is this expected? And generally speaking, those types of questions are easily answered by performing this type of analysis, and we can come up with and predict, what that well should have produced in a given month in the future against what it did, and then we can adjust accordingly. So that's useful to know, and just know that there are ways to determine all of that, and you don't have to guess. And so, that's always the challenge when you get that initial big check and then it drops really quickly. There's always a question in the back of your mind: is this expected? And usually the answer is yes. But again, this can be a tool. And if you have a question, if you need help with something like this, actually, this is what I do in my consulting practice: is primarily these valuations and appraisals for mineral and royalty owners. And then, obviously, if there's just hey, I want to understand, what the future royalty checks are going to look like, that's all part of this whole process, or the underlying information that we can use to help you make an informed decision on how to make the most of your minerals and royalties, which is why we're here. So yeah, thanks again for listening, and hopefully this has been helpful. And again, we'll link to the YouTube video that I mentioned in the show notes and some other resources out there to help you understand more about decline curve analysis and basically how we come up with the value for minerals and royalties.
Awesome. Well, thanks, Matt, and thanks for your technical expertise with this. It's certainly over my head, and I think a lot of folks, engineer or reservoir engineering was not why we got into minerals.
Yeah, so exactly. Well, thanks again for listening, and if you made it this far, thanks for sticking through all the technical jargon, and we'll talk to you in the next episode.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.